Hello, and thank you for joining us for today's webinar. My name is David Kaplan, and I'm a Vice President at Barron Capital on the institutional team. Today, we're discussing our oldest fund, Barron Asset Fund, and our mid-cap growth strategy with Portfolio Andrew Peck. Andrew is also Barron's co-CIO and has been the PM on this strategy and fund since 2008, after being the co-PM along with Ron Barron from 2003 to 2008. Andrew's done a great job as the fund has beaten its benchmark, the Russell Mid-Cap Growth Index, for the 1, 3, 5, 10, and since inception number as of 12/31/2022. Quite a feat. Please consult the prospectus for complete performance information. You can access that from our website at www.barronfunds.com. I'd like to encourage those listening to submit questions either in the Q&A box on the Zoom or by emailing questions@barronfunds.com. And we already have received a few questions ahead of the call. Andrew?
Great, thank you, David. Well, it was a good fourth quarter for Barron Asset Fund, both on an absolute and relative basis. The market rally, which began during the quarter and has continued through January, was obviously supportive of that. I think the most obvious explanation for this jump is probably the consensus view that the inflation rate and the associated pace of likely continued interest rate increases has likely peaked. So against this backdrop, the Russell Mid-Cap Growth Index rose about 6.9% during the quarter. Barron Asset Fund rose 12.2%. So that placed the fund ahead of that index for the full year 2022, which we're pleased about. And as David mentioned, the fund also closed the year ahead of that same index over a 3, 5, and 10-year period as well. So we're pleased about that as well. The fund's performance during the quarter was driven primarily by positive stock selection, which is a key part of what we're trying to deliver on as active managers and stock pickers. And the performance was also driven in part by the fund's traditional underexposure to higher beta stocks, which actually underperformed during the quarter despite the relative strength in the market. Most of the fund's gains during the quarter came from 3 sectors: information technology, healthcare, and financials. Within the information technology sector, the gains were led most prominently by Gartner, which is the leading provider of research on the information technology sector and also happens to be the fund's largest holding. At a high level, we think that Gartner's business is being driven by the growing pervasiveness of technology in all aspects of just about every business, regardless of whether that business is small or large, domestic or foreign. And that very powerful mega trend has continued unabated, somewhat regardless of any uncertainty in the economic backdrop, which has been very positive for Gartner. In addition, Gartner has a sizable conference business that brings together technology executives around the world to learn about important industry trends and to allow them to interact with potential technology vendors. That business had virtually been shut down during the depths of the pandemic, and it's now rebounding strongly as COVID concerns have largely receded and executives and others proved anxious to travel once again to attend Gartner's events. So that has been another powerful tailwind for Gartner as a business and for Gartner as a stock. Another strong performer within technology during the quarter was a company called Fair Isaac. That is a data and software company that owns, among other things, the well-known FICO score that's used for consumer credit verification. The company also makes software that's used broadly by financial institutions to communicate with their customers and also to reduce fraud in credit cards and other credit granting areas. And that company gained after reporting good earnings results during the quarter. Within healthcare, performance was driven primarily by longtime holding Mettler Toledo. Mettler is the leading provider of weighing instruments that are used primarily in laboratories and various industrial applications. Mettler reported good results, and its business continued to prove resilient in the face of the perceived macroeconomic headwinds that had been weighing on the market, and the stock performed well as a result. IDEX Laboratories is another longtime holding. IDEX is the leading provider of diagnostic solutions to the veterinary industry. Earlier in the year 2022, IDEX's business had been suffering from, among other things, a tight labor market that caused a shortage of veterinary technicians and led to a reduction in visits to veterinarians' offices. During the quarter, there were some encouraging signs that as the labor market has begun to loosen, the labor shortage problem is being solved in veterinary offices, and that's positive for IDEX, and I think the stock reacted positively to that. Lastly, in the financial sector, results were driven by Arch Capital, which is a specialty insurance company that benefited from strong pricing trends in the property and casualty insurance market, which is one of the key markets Arch participates in. And then in addition, Charles Schwab, the well-known brokerage firm, also gained during the quarter, really for two reasons, both because Schwab, like many financial companies, stands to continue to benefit from the higher level of interest rates that we experienced over the last year, and also because Schwab continued to attract significant levels of new client assets during the quarter, despite the obvious turbulence in the capital markets. So, bottom line, across the portfolio, I would say the large majority of stocks performed pretty well. Unfortunately, there were a couple of laggards, which are probably worth mentioning briefly. Zoom Info is a company that provides business intelligence software that's used mostly for sales and marketing purposes. Zoom shares dropped during the quarter after it reported weaker revenue trends going forward. I think driven primarily by slower purchasing decisions that they're now seeing by their customers, primarily those in the technology industry. Second company is the Trade Desk. Trade Desk is a platform that's used by ad agencies to efficiently purchase digital advertising for their clients across a variety of different platforms, personal computers, mobile devices, and online video channels, direct TV, and the like. Its shares were pressured by, I think, the well-known challenges that have been facing the digital advertising space that affected Trade Desk, as well as companies like Meta and Google and some other very well-known mega cap technology companies. Lastly, Fidelity National provides technology solutions to large financial institutions, and it also has services and technology that enable merchants to accept electronic payments. Fidelity's shares fell during the quarter after it reduced its financial guidance, primarily because its large bank customers were delaying some large technology investments because of macroeconomic uncertainty. At the end of the quarter, I would say the fund remained reasonably concentrated, which I think is appropriate for a portfolio like this, which is high conviction and research driven. The portfolio had 53 holdings. The top 10 positions within the portfolio represented around 45–46% of assets. 9 of those top 10 holdings, importantly, have been owned in the fund for longer than a decade. So those are all companies that we have a long history with. We clearly know very well, spent a lot of time with the management teams, done a tremendous amount of research on them, and their industry and competitive environment, and we continue to have great conviction in their long-term potential. Breaking down the portfolio a bit by sector or industry, about 31% of the assets at the end of the quarter were in the information technology sector. Breaking that down a little bit further, technology consulting, which includes Gartner, as I mentioned, as well as a company called EPAM, was around 10% of assets. Application software, which includes a bunch of names like Ansys, Roper, Fair Isaac, and Ceridian, was about 13% of the portfolio. And the remainder within technology was split across a variety of companies and sub-industries, including internet services, companies like VeriSign, and technology distributors like CDW. And then the second largest sector within the portfolio was healthcare at around a quarter of the portfolio. That broke down into life science tools at around 13%. Those are companies like Mettler Toledo, West Pharmaceuticals, Biotechne, and then
Brian, I apologize. We seem to be experiencing some technical difficulties. Hopefully Andrew will pop back on momentarily.
If any viewers on the line can just bear with us a second here, we will give Andrew a moment to jump back on. We'll hang tight here, David. Thank you.
Sure.
Inexplicably.
All right, you're good.
Hi, sorry everyone, my computer crashed for unknown reasons, but I'm back. I think I was saying that about a quarter of the portfolio is in the healthcare sector, split among life science tools, companies like Mettler, Toledo, West Pharmaceutical, Biotechne, and then the veterinary space at around 7%. That's IDEXX Laboratories that I mentioned a moment ago. And then the remainder of the portfolio, the other 45% or so, is spread across a variety of industries, primarily industrials, financials, and consumer discretionary. For the first time in many quarters, we actually didn't purchase any new investments for the fund during the fourth quarter last year. And this is really largely a reflection of our belief that our existing portfolio remains filled with really compelling long-term opportunities. And even after the nice rally this quarter, many of the stocks in the fund were down 20, 30, or 40% or more from where they were 6 or 12 months earlier. And we remain really optimistic about the potential for them to recover significantly from the rather indiscriminate sell-off in the growth space. We did add to a couple of positions in the portfolio, existing positions during the quarter. Most prominently, a company called Icon, which is the second largest participant in the something called the contract management organization space. Basically, what that means is Icon provides outsourced drug development services to pharmaceutical and biotechnology companies. Basically, as clinical drug trials have become increasingly complex and global in scale, the CMO industry is growing quickly, and market share within that industry has been shifting to large-scale providers like Icon. Working with Icon, I think, offers a variety of advantages to clients, drug developers, particularly smaller and mid-sized biotechnology firms that lack the internal infrastructure to run their the trials that are necessary to obtain regulatory approval for their drugs. And the other benefits to their clients include the economic efficiency associated with converting previously fixed costs to variable costs, and a significant reduction in the time and expense that's required to bring new drug treatments to market. Moving on to my outlook, which is something I'm often asked about, I always preface my response by saying that we as a firm and I as a portfolio manager really don't have a particular economic outlook at any point in time that informs the way we invest or the particular stocks we choose to own at a moment in time. With that all being said, I would say that despite the recent upward move in the equity markets over the past several months, the consensus among Wall Street strategists and virtually everyone you listen to on television, on CNBC and the like, has remained pretty bearish. But the reasons for their bearishness have been well known for many months to anyone who's paying attention. Rising inflation and interest rates, slowing economic growth, uncertainty about what this will all mean for corporate earnings, issues with reorienting supply chains, the war in Ukraine, et cetera. And so against that backdrop, I'm pretty optimistic that the recent upward move in the stock market seems to support the view that much and maybe all of this negative sentiment has been adequately discounted into stock prices. And I think this may be particularly true for high quality growth stocks with long duration earning streams, which are especially susceptible to changing investor views about the trajectory of interest rates. And as everyone probably knows, those are the sort of stocks that we own. And as a result, I'm optimistic that they are poised to do well. I'd say that sort of consistent with the fund's positive performance in the fourth quarter, we think the fund is positioned to do well during what will hopefully be a continuing stock market recovery. The reason for that is the fund consists of companies that benefit from secular growth drivers, strong competitive positions, exceptional management teams. And these are really the types of high quality businesses that we think should outperform their less advantaged peers during challenging economic environments and during periods when investors re-engage with the stock market. And most importantly, we continue to believe that the stocks in the fund have the potential to double in value over the next 5 years, which remains the key valuation benchmark we use and think about in populating the portfolio over time. So why don't I stop there? Hopefully that's a nice review of what happened in the quarter and see whether there are any questions that are on people's mind. David, perhaps you could see.
That's a great summary, Andrew. Thank you. First question is, why do you think the mid-cap space is so attractive?
What's interesting is that, and I think not necessarily very well appreciated, is that over an extended period of time, the mid-cap growth sector has been the best performing sector within the growth universe. So over the last 20 years, mid-cap stocks, as represented by sort of the key mid-cap growth index, has outperformed small cap stocks, mid-cap stocks, and large cap stocks. But more recently, mid-cap stocks have meaningfully underperformed. They've underperformed large cap growth stocks by almost 400 basis points annually over the past 3 years. And they've underperformed large cap stocks by almost 300 basis points annually over the past 10 years. So meaningful underperformance. And then in addition, mid-cap growth also meaningfully underperformed mid-cap value last year by about 1,500 basis points, almost historic underperformance of growth versus value. So, simplistically, if you believe that markets move in cycles, it's probably a compelling time to be considering an allocation to mid-cap growth stocks. But from a qualitative perspective, relative to small cap companies, I think mid-cap companies are particularly attractive because in big picture terms, mid-cap companies by definition have generally moved past the stage of greatest risk in their business. They generally have more seasoned and experienced management teams. They've generally established their niche within whatever market they compete in. And they generally have the resources to expand into additional markets or geographies. They have better access to the capital markets. And then relative to large cap companies, I think mid cap companies benefit from, by definition, starting from a much smaller revenue base than a typical large cap company. So all things being equal, I think it's easier to grow from, say, $2 or $3 billion in revenues to $4 or $6 billion in revenues than it might be to grow from 20 or 30 to 40 or 60. And I think part of the reason for that is mid-cap companies have greater room to grow within their existing markets. Generally, they don't have to grapple with the law of large numbers that I was sort of referring to and extrapolating the growth rates into the future. And they also have the greater likelihood of being taken over someday. Not that that is a key part of our investment thesis on particular companies, but it provides a certain amount of ballast in the valuation of mid-cap stocks in many sectors. I think particularly in the information technology and to a somewhat lesser extent the healthcare industry. And then I'd also say quickly that large cap returns, I think part of the reason they've been as strong as they have relative to mid-cap over the last 5 and 10 years is that large cap indices, particularly the growth indices, have been driven by the performance of a relatively narrow group of mega cap technology companies that we're all familiar with. And I think given some of the challenges companies that we all know within that bucket are facing, makes it at least uncertain as to whether that sort of market leadership can and will be reasserted by those same companies go forward. So that's my view on mid caps.
Got it. Okay. And you've had some great success with long-term holdings, and you talked about Gartner and IDEX. What are you doing? What's Barron doing to find the next Gartner or IDEX?
Well, I think I think the key to finding great long-term holdings is having a consistent investment process and a great research team to execute on that process. And the process that I follow today, and I think this is really true across all of the portfolio managers here at the firm, has remained the same and consistent throughout the firm's history. And at the same time, our research team has continued to grow each and every year throughout the almost 25 years that I've been here at Barron, generally by around 2 people a year. We now number 43 people on the research team. We all work together closely, sharing and researching ideas alongside one another while following this consistent investment process. So I think that provides a very compelling framework for finding new ideas that meet our criteria. And then lastly, I guess I'd say, clearly most stocks are still cheaper than they've been in a long time. Again, particularly true of growth stocks of the kind we look for. So with that backdrop in mind, I'm optimistic that there's no reason we shouldn't be able to continue finding compelling long-term ideas for the foreseeable future.
Got it. You've been a PM at Barron for a long time now, and you've seen some difficult market conditions. Going back thinking 2000, 2008, and last year. What have you learned from those experiences?
Well, I guess what history seems to show is that, at a minimum, every 10 or 15 years, there seems to be a major market dislocation. And during these dislocations, the market tends to overcorrect, and things never turn out to be as dire as most people believe. And in these sorts of environments, like the one I think we lived through certainly during the first 3 quarters of last year, the market tends to become irrational and often punishes the best positioned companies as severely as it does some of the worst ones. And again, against that backdrop, growth stocks tend to suffer disproportionately as they did last year, again, particularly in the mid-cap space. So, stating the obvious, I think returns are likely to be better going forward for people when they invest after a meaningful correction like the one we've just experienced. I think history also has proven that no one sells at the top and buys at the bottom, even though many, if not most people, keep trying to do that. I also think history shows that the consensus is almost always wrong. The NASDAQ just had the best month of January since 2001. I don't think a single person went on TV a month ago predicting that. I think just about everyone went on TV and, in the Wall Street Journal and Barron's, et cetera, predicting just the opposite. So it just goes to show you, that following the consensus is really, if ever, a strategy to performing well over the long term. And I think lastly, I'd say history also proves that investors get rewarded for buying and owning great companies and letting them compound over time without getting overly concerned about what happens during the inevitable market cycles like the one we just lived through and perhaps are continuing to live through. And that's clearly what we try to do, here at Barron Capital, what I do, in the mid-cap growth space with Barron Asset Fund in particular. And so I remain very optimistic that this is a compelling time to be contemplating investments in, in the equity market broadly, but in the mid-cap growth space and in Barron Asset Fund in particular.
Right. And I also think that our clients and shareholders have benefited by how we've been consistent in our approach and application of our investment strategy. We're never chasing yesterday's story, hoping that momentum will continue. I'd say, as you mentioned, you haven't added anything to the portfolio in the last quarter. The names and the types of names stay relatively similar quarter after quarter and year after year, looking for the same types of businesses. Another question I have had is, you've demonstrated historical aversion to a couple sectors, namely materials, energy, utilities, and even consumer staples. You want to share with the viewers why?
Sure. I guess I'd say, essentially what we try to do is probably many, if not everyone on the call knows, is find really well-positioned, secularly advantaged growth companies with serious competitive and compelling competitive advantage, great management teams that we think we can buy and own for long periods of time and compound our investors' money in the process. With that sort of framework in mind, I think it is, and doing all of that from a bottoms-up perspective without sort of a macroeconomic overlay, meaning I don't have a particular view as to where interest rates or gas prices are headed tomorrow or next month or next year. So sort of looking at the investment universe through that framework, I have found it difficult to identify companies in what I would call historically more cyclical sectors like energy and materials, where one can model out with confidence earnings trajectories over an extended period of time without having an important underlying view about where certain underlying macroeconomic variables like material prices, gasoline prices, et cetera, are headed. And then in addition, and somewhat consistent with industries that operate that way, I think it is historically difficult for companies to establish true and compelling competitive advantage and differentiation within those sorts of spaces. So for both those reasons, I tend to avoid those particular industries. And then, I'd say within the utilities and, to some extent, the consumer staples area as well, as investors looking for, again, sort of long-term secular growth, trying to find companies that have a compelling set of drivers within their industry that should lead companies, well-positioned companies in those industries, to grow at above market rates for extended periods of time. I think that is historically challenging to do in the utility sector and to an extent in the consumer staples area as well. So within the world of consumer, I tend to be more attracted to companies in the consumer discretionary sector, many of which share a lot of attributes with consumer staples companies, but where well-positioned ones, in our view, tend to have more durable growth rates over an extended period of time.
Got it. I have one last one. You talked about by name a number of your IT holdings and healthcare holdings. Could you describe maybe in a little broader sense why you're attracted to those and not some of the more traditional IT names or traditional healthcare names such as hospitals?
Sure. I guess what I'd say is, within the world of information technology, generally speaking, and clearly the last year has been a challenging one for many stocks within the technology sector, but one thing that tends to be true across the technology sector is there are a lot of fast-growing companies, broadly speaking, particularly when the underlying market or economic environment is good, and there are a lot of very well-known positive secular trends that are driving growth in the technology industry. What is more challenging, at least in my view, is finding companies that are truly competitively differentiated and advantaged in ways that we think can be perpetuated for long periods of time. So in the technology sector, areas that represent a reasonable portion of the sector for many investors are areas like hardware manufacturers of various types, memory chip manufacturers, semiconductor manufacturers, et cetera. Those are areas where, at least historically, it's been more challenging to, again, find competitively advantaged secular growth companies as distinct from more cyclically challenged companies when markets shift as they have recently. So I tend to have little exposure there. And then within healthcare, I would say, broadly speaking, healthcare also is a sector that is growing for many obvious reasons: the aging of the American and the global population, and the development of more, simplistically, drugs and medical devices to treat that older patient with. So more money is being spent on healthcare every year, and no matter whether it's Democrats or Republicans in power, that spending goes up, and I'm not sure it's ever gone down on an inflation-adjusted basis, and probably never will. So against that backdrop, it's an exciting area to invest. However, what I found over the course of my career is investing in companies that have, within the healthcare sector, that have the government as a big source of payments for those companies. So companies like hospital companies, you mentioned, certain health insurance companies, et cetera, tend to be areas where there's the potential for the biggest payer of all, the U.S. government, to step in and, whether it's rational or irrational, make broad brush changes to the way they reimburse for certain services, drugs, et cetera. And in instances like that, stocks that are exposed have a lot of downside risk. So I try to identify companies that are growing from some of the positive trends in the healthcare sector, like an IDEXX Laboratories, which is in the veterinary space. So a different set of drivers than the human space, obviously, but somewhat similar: more dogs and cats, more money being spent to care for them, and all of the money that's being paid for veterinary services, virtually all is being paid out of pocket. So it's a more attractive payment base. And then I also have an investment in a company called Cooper Companies, which is one of the leading manufacturers of contact lenses. Again, positive secular growth behind contact lenses as more people age, and greater wealth in emerging markets allows more people to have corrective vision enhancements. And against that, virtually everything that is paid for contact lenses, again, is paid for out of pocket. It's not paid for by Medicare, Medicaid, et cetera. And so in my mind, that's a more attractive area within the broader healthcare space to gain exposure to some of those growth trends.
Great. Well, thank you, Andrew.
Thank you.
This concludes our today's webinar. A recording of the webinar will be available on our website, www.barronfunds.com. I want to thank the Portfolio Manager, Andrew, for his comments, as well as all of you for joining today. Most importantly, I want to thank you all for supporting the Barron Fund family. Goodbye.